So, ladies and gentlemen, good morning, and I trust that you're all doing well. So, today we are going to look at complex group structures. Complex group structures. Now, in our previous videos of classes, we've actually gone through and looked at basic consolidation. Basic consolidation. And we've actually dealt it in parts. So you had like about a 6-video lecture on these things. And in that, you learned how to do the basic consolidation. So today our focus is on the complex group structures. Complex group structures. So here we look at the corporate reporting level, ACCA, strategic business reporting. So that is where it covers in this video. So we are going to look at complex group structures. We are going to actually stay there and understand how we deal with that. All right. It's not really a difficult thing if you take time to follow it. So I'll be giving you the explanations to it. So as you follow it, you'll be well versed in the area and ready for any type of question that comes your way. All right. So now we are going to look at basically two forms of complex group structures. Two forms of complex group structures. So the first part of the complex group structures, we are going to look at the vertical group structures. The vertical group structures. And on the other side, we are going to look at the mixed or the D shapes. The D shapes. All right, so these are what we are going to look at. Now, don't forget that everything that we are doing is because of consolidation. And consolidation is governed by IFRS 10, combining entities' financial statement together. So it is governed by IFRS 10. Now, IFRS 3 are the main issues here. And if you remember your IFRS 3, so the issues about complex group structures are mainly about IFRS 3 and IFRS 10. But most importantly, our focus is on IFRS 3 business combination, because we are going to have a form of combination in terms of the complexity in the structures. So that is what we are going to look at. And if you know your IFRS 3, when it comes to business combination, talks about the acquisition accounting. All right, acquisition accounting, or the acquisition method of accounting. Okay, you know, when it comes to associate, it talks about IAS 28 talks about the equity accounting. But when it comes to subsidiary and parent combination, parent acquiring a subsidiary, we use acquisition accounting. And acquisition accounting has 4 major things under it. So acquisition accounting says that, number one, anytime somebody has control or buys a subsidiary, which means control, the first thing that we need to do is to look at the acquisition date. All right, it first talks about the acquirer and the ownership percentage of the acquirer. So the first issue here we are looking at is going to be the ownership, which is the percentage of ownership. How much has he acquired? All right, how much has he acquired to gain control? Then acquisition accounting says, number 2, we need to also lay hold of the acquisition date. The acquisition date. So we need to find these dates, the acquisition date. Then acquisition accounting also tells us to calculate goodwill on the acquisition date, goodwill. And lastly, the NCI determination. So when we talk about complex group structures, these are the areas of our focus. These are the areas of our focus. And of course, if you are asked to prepare a consolidated statement of financial position, you know that the only thing that is not here is the group retained earnings. And if you are asked to even prepare a consolidated statement of profit or loss, you don't really need the group retained earnings part of your working. So you will be stuck with these four. So this is coming from the IFRS 3 standard. So let's take them one by one and see how, if a question comes in the form of a vertical group, we will deal with it in terms of these four perspective of acquisition accounting. And when the question is about a mixed or a D-shaped complex group structure, how we will also deal with it in terms of these four things under the acquisition method of accounting. All right. So let's pick first the vertical. So we look at the vertical group. The vertical group. All right. So let's start with some illustrations or some examples. Okay, so let's say the P is the parent. Okay, so P acquires a subsidiary, S. And so, of course, we will have to put in here the date, okay, the date of acquisition, and we will also determine the control percentage. So let's say they have control 80%. They bought 80%, which means they actually have control. They have control. So what you do is that you put in the dates and everything. So we will come to that. We will come to that. I'll further the illustration for you to see that. But for the meantime, as you see, P has acquired S of 80%. Then let's say S2 acquires another subsidiary. S also has a subsidiary. He also has control because let's say S also purchases 75% of SS. Then issue of ownership. So the first thing we are looking at here in the vertical group structures, we are trying to talk about ownership. All right. So how is the ownership structure is, as you can see. So between P and S, what you see is that P has control of 80% of S, and therefore there is an NCI portion of what? 20%. That's it. Now, when it comes to S and SS, you could see that between S and SS, S has 75%, meaning that even between them, what happens? SS, there is kind of NCI of what? 25%. But you do know from IFRS 10 that S is an intermediary parent, and therefore he's not actually required to prepare consolidated financial statement because S itself is also a subsidiary of P. So the one who is actually required to prepare consolidated financial statement is P. I think you learned this thing from the very first video, okay, on group accounting. All right. Now, if that is the case and P is the one to consolidate, what is P holding? P's holding in SS. In SS. P's holding in SS. So you do realize that in terms of the consolidation, you need to find what we call the effective control, and therefore the effective NCI. So you do realize that when it comes to P and SS here, what will happen is that the effective control, because you see already there is control because of what? Relation. Because if P owns S, then S owns SS, then it means that P actually owns SS. Yeah. So basically that is that. That is that. That is why. So take it like a grandparent who has given birth. So your grandmother. So you have your mother, yourself, and your grandmother. So your grandmother can actually have control over you simply because your grandmother is the mother of your mother. It's as simple as that. Okay, so that is how it is. Okay, so the effective control of P in SS will be given by P's percentage of ownership multiplied by S percentage of ownership in SS. So P's percentage of ownership in S multiplied by S percentage of ownership in SS. So that is what will happen. All right. And this will give us 60%. Oh, yeah. So you have 0.8 by 0.75. And that will give us 60% effective control. So that is that. Therefore, the effective NCI between P and SS will be what? 40%. So that is that. So when you are doing the consolidation for P and S, that one is 80-20. But when you are doing the consolidation for P and SS, it is 60 and 40. So basically, that is that. That is that. Let's take another illustration. So illustration, let's say illustration 2. Let's call it another example 2. Example 2. All right. So in this example, I'm going to follow suit with the same analogy. So let's say that S or P, let me begin with P. So P, which is the parent, is the same thing. Just trying to let you remember some of these things. So P is into S, we still have what? 80%, which tells you that P has control on S, and therefore with regards to this one, there is NCI of what? 20% like you did. So if S also acquires SS, let's say 60%, it means S also has control, but we know that S is an intermediary parent who is not meant to do the consolidation. So what then happens? What happens here is that between P and SS, what will be the effective control? The effective control? Yes, you are right. What you are thinking is right. So 80% by 60%, and that gives us what? 48%. Tells you that, therefore, the effective NCI when it comes to the relationship between P and SS is what? 52%. So you see, it's not all the time that the NCI has to be that kind of lower portion. But so when it comes to the complex group structure, you see, there is still what? Influence. So it doesn't matter the NCI is what? 52%. There is still control. There is still control. So in this scenario, you have to understand that there is still control. There's still a control. All right. Better still, they have influence. Control via influence. So basically, that is that. All right. So this is what we are building upon. So in terms of the ownership, this is what happened. I.e., in terms of your, what do we call it? Your group workings one. That is what we are trying to develop here. All right. So in terms of ownership, this is how you figure it out. This is how you figure it out. Now, the next thing we are going to do is to talk about the acquisition date. The acquisition date. So we've looked at, like I told you, we are looking at IFRS 3 issues, all right, which is the acquisition accounting. So you've seen how the ownership can be, right? Then how do we go about in terms of the acquisition date? In terms of, so when is acquisition? When has, so in this scenario, when has P actually acquired S? When has he acquired S? All right, so let's look at the following scenarios here. So number 2, we are looking at the acquisition date, which is very, very, very important. The acquisition date. It's very, very important. Here we have 2 scenarios. Okay, and I'm going to actually exhibit them for you to see. We have 2 scenarios. So you see, the acquisition date of the SS in this vertical group depends on 2 situations. It depends on 2 situations. Situation number 1. So be very, very careful in your exam to spot this. So we are looking at the situation number 1, where parents acquired subsidiary S. All right, before subsidiary S also acquired holdings in the subsidiary. The subsidiary. SS. So the timing is very, very crucial. It's very crucial. So look at this example. So let's say we have P who acquires S. And let's say he bought 75% of S, meaning that the NCI will be what? 25%. Now, the date of acquisition, and you have to look at that from your question. Very, very important that you fish those things out from your question. So the acquisition date this happened was, let's say, 1st January 2021. So that is probably when they bought it. Then S also bought SS, and he bought like, say, 60%. All right, but he bought it on 1st January 2023. All right, so this is the situation we have. Okay, so we need to find the acquisition date, because what you need to understand is that according to IFRS 3 acquisition method of accounting, the day you have control, that is the day you determine goodwill. Okay, that is the day you determine goodwill, and you also determine the NCI. So the day that you see that there has been a control, it is that day that you go ahead to calculate the fair value of the net asset of the subsidiary. Okay, then you bring it together, then you get your fair value of net asset at reporting date, which you will use in calculation of your goodwill. So it is very important that you spot the date of acquisition. You spot the date of acquisition. Now, in this scenario, what then happens? What you see here is that as far as the parent is concerned, as far as parent P is concerned, when has he acquired? Of course, as far as this one is concerned, you will see that the date of acquisition will be what? This date. Because he had control in S. So the date that S is also acquiring SS is the date that P is also acquiring SS. Why? Because P controls S. So it's as well as P buying SS. All right. So that is that. Because what you do know is that because S is controlled 75% by P, even before purchasing this, he will seek consent from P, the approver, most of the time, to even go ahead with the purchase. So as far as P is concerned, the date of acquisition of SS is actually 1st January 2023. So bear in mind, this looks a little easy because it makes common sense approach. All right. Now, let's look at the second scenario. Let's look at another scenario. So that is the first scenario. Let's look at the second scenario. The second situation is when the parent acquired subsidiary. The subsidiary. Sorry, let's do parent acquiring the subsidiary. Let's do it like that. The subsidiary S. After, so this one is not before. After subsidiary S all right, acquired holdings in the subsidiary SS. All right. So how do we approach this? So let's look at P, buying holdings in S. This is 75%, but the date here is 1st January 2023. So this date is actually an after date when S had already purchased SS 60%. So this date is 1st January 2021. So this is how it is. So what will be the date of acquisition of P into SS? Of P into SS. So it tells you that as at this date, S has already bought SS, okay, SS. So it looks as if P wasn't even in picture. So the date that P will buy S is the same date P has also bought SS. Because as far as this thing is concerned, SS was already into S before S was bought by P. So this one means that, so this means what you see here is that the meaning of this is that S and SS were acquired on the same date by P. All right. Acquired on the same date, which is 1st January 2023 by P. So these are the two scenarios that you may have. All right. These are the two scenarios that you may have. All right. So that is that. That is that. Now, in terms of consolidating these scenarios, how do you go around it? There are basically two approaches. So when I'm dealing with the two approaches, I will then discuss how you are going to go about doing your goodwill and also doing your NCI. And I will show you some excerpts of the group retaining earnings just in case you are doing a balance sheet. All right, so that's how it will be. Okay, so now, how do you do consolidation of the subsidiary? Because we are going to use that to do the goodwill part of the acquisition accounting and the NCI part. And I'll give you some small breather on how your group retained earnings will look like. Then after that, we go into the D shape. So from the D shape, we will start picking up questions to deal with. All right. So let's look at how it will be. So consolidation of a subsidiary. How do you consolidate the subsidiary? Actually, there are two methods. The method one is the one-step approach. The one-step approach. And that is what we will be focusing on. All right. Actually, that is the one recommended for your exam. Okay. So that's the one recommended for exam. But we also have the two-step approach. The two-step approach is what we actually do in practice. In the real world, that is what we actually do. So that is the one mostly practice in the real world. How do we do that? What you will do is that, like you see, if P, so the relationship is like this. So what will happen is that you first consolidate S in SS into S, then you have a full financial statement. Then when you are done, you consolidate S to P. So that is how the two-step approach works. But for your exam purposes, we are going to stick with the one-step approach. Because if you decide to go with a two-step approach, it will be very, very time consuming. You are doing kind of two consolidations at a time. So the one-step approach, what do? Your first thing in terms of doing your consolidation, you need to do your workings one, and that is what we've actually established. All right, we've actually established that. Okay, so we are going to look at what we did, the last illustration that we did. So let's put up the scenario there again so that we will pick that one and use. So in the illustration that we did, that we had, so we are going to use this. So we had P, who acquired S, and S, who acquired what? SS. So that is what we are going to use. All right. And remember, in that illustration, the control between P and S was 80%. Let's use that one. And when S also had a control, like I think 60%, right? Yeah, that illustration that we did. All right, so let's use this one for our approach to go about doing our consolidation. So of course, yes, we will do our group structure. And this is the group structure that you see. All right, so Perkins 1, you do the group structure. Okay, so the group structure, like you see, you do P, S, S, S. All right, then you put the control percentage, CI control, we have 80%, right? So the NCI for this one will be like what? 20%. Okay, then you put in the date of acquisition. All right, so check the two scenario type. All right, check those two scenarios, whichever one it is, check that one. All right, so that is that. Then here, let's say S had bought 60%. So what we are actually going to do is to do our effective control here, the effective control. And how do we do it? Yes, I get what you think. 80% of what? 60%. And that gave us something like what? 48%, right? All right. Then our effective NCI is what? 52%. That is 100% minus 48%. So that is what we have. So you do your group structure, all right, down. So that is that. Then you go to your workings too. And I'm not going to actually draw the things for workings too. You already know it in your the very first video of group consolidation. So it will be the same, all right? It will be the same. But the thing is that you are going to prepare it for the subsidiary and also for who? The subsidiary. So that is how it is going to be, all right? That is how it is going to be. So you do the same thing that we've done. So workings 2 is the same. Same with the subsidiary. like the one fair value of net assets of subsidiary. So here you see that the subsidiaries are two. So go and visit the basic consolidation group. The basic consolidation is the first video, all right? The basic consolidation. So you are going to do two, all right? One for the sub and another one for what? The subsidiary. So don't forget, you are doing two. So you do fair value of net asset of subsidiary, then you do another one. When you are done with it, you do another one, fair value of net asset of the subsidiary. All right. So don't forget that. But whatever goes in there are the same. So visit the group accounting video one, the part one, then you actually see that. But the most important thing that you are doing is that you need to be careful. Check the acquisition date. Check the acquisition date. It's very, very important. Check the scenario for the acquisition date. All right. So check the time of the acquisition. Very important. Then we come to the next thing under the acquisition accounting. So this one too is under acquisition accounting. It is for determination of goodwill. So I mean the at acquisition part. So at acquisition, then you have to value the assets, all right, and the liability. Let me remind you of this. All right. Let me remind you of this. When we say fair value of net assets, so fair value of net assets of, let's say, the sub or whether the sub, all right, then you do your at acquisition, at reporting, then post acquisition. Now, my focus is to help you understand this part. It is the net asset, which should be measured at what? Fair value. Okay, so it tells you that, and you people, everybody doing corporate reporting has actually passed through something like business acquisition, all right, business valuation. You remember? So if you are selling off the company, the asset has to be at their realizable value, at their fair values. All right. So that is how it is. So you will need the fair value of the net assets, the fair value of the net. And when we say net assets, what does it mean? And that is what I want to remind you. When we say net asset, think about the accounting equation. All right. The accounting equation is what? Asset is equal to capital, or these days call it equity, plus what? Liability. Now, what is net asset? Net asset. Net asset simply means what? It simply means your assets minus your liability. Net, so that you get the net of it. Your asset minus your liability. Now, watch this. If you get asset minus liability, what does it mean? It means what? Equity. It's as simple as that. And that is why when you are doing the fair value of net asset, which is your workings too, you actually look at the equity aspect of the subsidiaries. Then that is why you start with your stated capital. You remember that? You start with your stated capital. All right. So, and equity accounting, I mean, equity doesn't normally move. And that is why you always get this. All right. So be careful about that. That is why you are looking at the equity component. So there can be share premium, share due. There can also be something like, what do we call it? Retained earnings. Most importantly, retained earnings. So there can be retained earnings. So the retained earnings most of the time, because the retained, you see the stated capital that you see is always at reporting. So it tells you that it is the same thing that has been run. I mean, when you go and establish a company and you put in a stated capital, how often do you change that stated capital? So that is why post-acquisition is nil, because it keeps being the same. But your retained earnings is either you make a profit in 1 year or you make a loss in 1 year. So if you had a figure here, it's either it went up or it came down. So if it went up, then it means you have this. But if it came down, then it means you are looking at what? A negative movement. So that is that. Now, these are the things. Of course, you may see some preference shares. I will educate you on preference shares later, because preference shares doesn't form part of the equity of a business. Remember that. Preference share is actually a liability. Okay, so normally what you do is that when you have preference share, you normally add it to the NCI. All right, so that is that. I will educate you on the preference share treatment. Okay, as we move on. All right, now, if you do this, what you've done is actually solving this problem. So fair value of net assets, that is what you've done. However, the question can tell you that as at the date of the acquisition, okay, there were some assets that were carried at their carrying amount instead of their fair value. So if you had to use fair value and they did carrying amount, then it means that you have to bring back the excess that was not considered at the date of the acquisition. And that is why you always see what we call what? Fair value adjustment. So you do the fair value adjustment depending on, and the fair value adjustment, ladies and gentlemen, bear in mind, it can be any standard. It can be IAS 38, it can be IAS 16, can be IAS 2, can be, and you see, when you what you see, and please, I would advise that you go back and watch my video on deferred taxation. It's very, very important. You will see that adjustment that has happened is actually supposed to suffer some kind of deferred taxation. It actually supposed to. Okay, it's actually supposed to, because what has happened is that if it is revalued, then it means there is a revaluation surplus. From the carrying amount to a fair value means that there is a revaluation surplus, and revaluation surplus can come up with some temporary differences, for which most of the time, for according to the recognition of IAS 12 deferred taxation, anytime there is a temporary difference, you have to consider deferred taxation. All right. So be careful. If the question tells you that it gives rise to deferred taxation, bring it into play. All right. This fair value adjustment, depending on the standard it is, if it is IAS 38, then it means that you have to do fair value adjustment, which is amortization or impairment. Now, you now have to remember everything about IAS 38. For example, IAS 38 says that intangible assets, all right, with a finite useful life is amortized. So if it is those with a finite useful life, what you do is that you do fair value adjustment, amortization. Then you will have to find a subsequent measurement. So it has nothing to do with the initial measurement. It has everything to do with the subsequent measurement, and therefore you do the amortization on the at reporting. So the movement here will be something like this. However, assuming that it was an intangible, okay, a brand or something, and you are told that it is having an indefinite useful life, don't forget, indefinite useful life, or it is renewed, the value of the asset is renewed indefinitely, then you can't amortize those ones. But what you can do is that you can test for impairment on those ones. And if the question gives you the impairment to use, then fine. But if the question is silent on impairment, then it means that it's as well as having a land which is not depreciated. So if it is intangible asset without a finite useful life, look out for impairment of that fair value adjustment. If you are not giving, then it means that it's not there. So you will leave everything here at this point here. So there wouldn't be anything of this sort. So take those things in mind. Of course, it can also be the fair value adjustment can also be receivables, and you have to apply IFRS 9 credit losses, if any. It can be IAS 2, and you have to understand that the reporting one should be the lower of cost and net realizable value. So it depends on the standard that comes at the fair value adjustment. Of course, you continue with your PAPs and all those things. So go back to the lecture on group accounting, the very part one that we started. Then most importantly, your working stray, is your goodwill. All right, your goodwill. So how do you do goodwill in this vertical group? So the goodwill, you know that you have to do it for the two. All right. So I encourage that you adapt this methodology. So you put the subsidiary S, then you bring subsidiary what? SS. All right. So you do your purchase consideration. And like you know, the purchase consideration can be any form, can be any of the five: cash, deferred, share for share, loan notes, or contingent liability. Now, the contingent liability is also another thing you need to even consider even here, because contingent liability at acquisition is measured at fair value, unlike the way we treat it in IAS 37 provisions and contingent asset and contingent liability. Here, what you do is that you measure the contingent liability at fair value, even if it's not probable. All right. So you measure it at fair value. Then at reporting date, what will be its figure? If the fair value changed by going up, then it means that the difference, okay, you are going to pay kind of an extra consideration. But if it came down, then it means that you have also had a gain on bargain. So those will be focused in your group workings 5. All right, so understand these things, okay? Understand these things. So it's coming from each standard, not necessarily you memorizing formatting consolidation. All right, so that is that. So you bring your purchase consideration. All right, your purchase consideration. Okay. All right. Now, let's come to the other side. So what you realize is that what we did, P bought 80%. All right. So whatever money that S is using to buy SS, since we are doing the consolidation for P, how much do you think P used to buy SS? P will use 80% of the purchase consideration between S and SS. That is how P row comes in. So it will be 80% of what is used. I mean, what S uses to buy SS. All right, SS. Because why? Because P, as you see, doesn't own all of S. He doesn't own all of S. This he owns only 80%. So looking at his part in terms of dealing with SS, it will be only 80% that he has in S that is actually buying what? SS. So please take note of that. So that is how you derive the. Of course, we will look at some examples. I'll pick 2 past questions, then we will look at that. Then once you get your purchase consideration, and as you know, it can be share for share and all those things, can be cash, can be all those things. When you are done, what do? You bring the NCI at acquisition, right? Fair value of NCI at acquisition, right? So as far as P and S is concerned, what is the NCI here? NCI is what? 20%, right? So if it is proportionate, they are using, you apply 20% on what? The fair value of net asset at acquisition. But what about when it comes to SS? Yes. What am I guessing you are thinking? What is the NCI? That is what you did here, the effective. So the NCI is what? 52%. So you'll be using 52%. Okay. 52%. All right, as your proportionate method. If you are giving the fair value straightforward, then that's fine. But most of the time, it will be proportionate. So that is the fair value here. All right, so the same here was 20, here will be using the effective NCI. All right, so that is that. Then when you are done, as usual, you less what? Fair value of net assets, all right, at acquisition, which is coming from your workings too. All right, so you less that. So this one too, you do the same thing for them. All right, so you get what? Your goodwill. at acquisition. Check. I mean, check if there is attributable goodwill. Check all those things. All right. There's attributable goodwill, depending on the nature of the question. And it goes back to what we've been doing in our what do you call it? Our group accounting part 1. All right. And remember, if the proportionate method is used, the goodwill goes to the parent only. But if the fair value is used, then it is the total goodwill for the entire group. All right. All those things are explained in the very first video. So you total the goodwill. So total goodwill. All right. And so you less any impairment loss. And again, depending on the method that you use, if it is proportionate, it means that since the goodwill is only for the parent, then it means that the impairment to only also be what? For the parents. You don't share that. So you less the income. So you get what? Here you get your goodwill. Carry down. So basically that is it. If there is any preference share issues, yeah, so in the subsidiary or the subsidiary, that's you bring it in. All right, so that's basically it. Okay, so this is how you do your goodwill. It's easy. You know this part already. The only thing you've done is to add this part, doing 80%, all right, of what S used to buy SS. Then fair value of NCI will now be the 52% using the effective. Okay, use the effective. All right, so that is that. Then the last thing per acquisition accounting is how we would do workings for. All right, workings for, which is our NCI. Our NCI. So how do we do our NCI? The same thing, just as you have done there, because you do NCI here, you also do NCI here. How do you go around it? All right. So what you do is that you have NCI at acquisition. All right. That is what you had in your workings 3 already. Okay. So you had it here. All right. Using the 20% and the 52%. Don't forget that. That here it was 20%, but here it is what? 52%. So you start with those. All right. So that is that. Then what do you do? NCI share of post-acquisition profit. You remember that, right? Of post-acquisition. The post-acquisition profit will be at your workings too. So whilst you are sharing, what percentages are you using to share? 20% here, 52% here. All right. So that is that. Don't forget that. Don't forget that. All right. So that is that. If there is any share of impairment, you share the impairment, okay, depending on the methodology that was used. So if they use the fair value method, then you have to share the impairments. All right. So if they use the proportionate method, and most of the time when the question is about this complex group, they definitely use the proportionate method. So you won't have to worry yourself by bringing the impairments here. But of course, if impairment is applicable here, then fine, you know what to do. All right. But what you should bring in is that you need to less what? The NCI, all right, share of S, the percentage consideration, all right, S used to buy SS, because it's also another NCI you have in the, and I think it's simple. You don't own everything in SS. So you need to take off that part. Now, so you less NCI, all right, share of S, cost of investment, or what we call the purchase consideration. All right, in SS. And what is that? So our NCI is what, 20%, and we will multiply it by the S purchase consideration in SS. Do you remember that? So it is not the one here. It is not the one here. It is actually the full amount that they used to purchase that. So of the purchase consideration, S used to buy what? SS. So you have to less that. And don't forget, like I've said, if there is any impairment, you have to bring it in. All right. So please take note of that. All right. So you total it. You total it. I think I initially mentioned about preference share. Preference share is at the NCI, not the goodwill, please. So that is that. All right. So therefore, you total your what? NCI. All right. So this becomes your total NCI. All right. So if there is any preference share from any side, then you add it up here. All right. So that is that. So the only thing that probably I'll add here is how then will your workings 5 be like? It's not part of acquisition accounting anyway, but you'll be definitely preparing balance sheet. So how then will your group retained earnings look like? So your group retained earnings, as usual, every other thing will come. But my focus is to show you how you go around with the because there is an SS here. So what you see is that, of course, you have your parent. All right, parent retained earnings, which is the 100% of it. All right, you have that. But what I would want to show you is that you have to bring in the CI share of post-acquisition profit in the S, and here it will be the 80%. Remember that it will be the 80%. And the same thing, you do another one for NCI share or post-acquisition in the, okay, I did S here, but it's supposed to actually be the S first. Then you do another one in the SS, which your control is what? 48%. All right, so this is that. Then every other thing else follows. Okay, every other thing from our what do you call it? Our group accounting video 1. So go to YouTube, check the group accounting video 1 on my channel. All right, so that is how vertical consolidation looks like. That is how it looks like. It's as simple as that. Now let's look at how the mixed group or the D shape also looks like. The mixed group or the D shape. Let's look at how you go around it. Okay, so here we talk about the mixed group or the D shapes. Or the D shapes. Why do we call it D shape? I think you have an idea very soon. All right, so let's pick an example. All right, of course, we are talking about issues of IFRS 3, so issues of ownership. All right, issues of ownership. All right, now we have P, who is acquiring S, and S acquiring who? SS. So let's say P acquired S, which is 60% control. Then P also, S also acquired, let's say, SS 20%. You see, between S and SS is not a control, it's associate, as you see. So P wouldn't, as far as control, nominal control is, what you see in the D shape is that you will see P also coming to buy SS of, let's say, 40%. 40%. So that is what you see. And you see, there has to be control between P and SS when you have more than 50%. All right, so that is that. So what do you see here? You see that the nominal control here, all right, between P and SS, because P and S is clear. But the nominal control between P and SS is that what you see is that P has 20% because he has S buying into SS, and he also has what? 40%, which makes it what? 60%. So there is control. So that is it. So there is control. Nominal, there is control. And that is what makes it possible for P to consolidate SS. So nominal, there is control. But let's look at the effective ones that you will use. All right. So this is just to prove that the P has control over SS. All right. Let's therefore look at the effective control. Of course, our focus is always on the effective control. But you first have to test this, because what you should understand is that had it been like P had bought 20%, there wouldn't be control. It would be 20 plus 20, which is 40, which is not control. All right, so that is that. So you have effective control here. Effective control, therefore, will be what? 60% multiplied by the 20%. I know you know that. Plus the direct purchase of 40%. So that is what will happen. And so that will give you what? 52%. Okay. So far as you get the nominal control, even if here is less than 50%, there is still control. Like the example we just did prior to this one. Then that tells us that our effective NCI for the relationship between P and SS will be what? Yes, your guess is right. 48%. So that is that. So that is how the ownership actually looks like. So let's go back to the acquisition date so that we actually find out when there is control. So 2, acquisition date, because when we are done, we move on to goodwill and the determination of the NCI. All right. What then happens? So let's say P acquires S and S also acquired, let's say, SS. Don't forget our 2 scenario step applies. Okay, so we are looking at this scenario 1 is looking at what? P buying S. All right, so P buys S, all right, before S buys into what? SS. So that is what we are looking at. All right, so let's say and look at the scenarios very well. So I'm going to change the ink. I'm going to use the blue ink for you to see. So let's say this one is 1st May 2021. Okay. Then, so I will mix it up. I won't even use this. I won't even go back to using this scenario because P is also going to buy into SS. All right. So you can scrap this off. All right. Let's scrap this off for the meantime. Actually, you realize that it is going to show up itself, all right, in the scenarios. You will realize that. So let's say you have 1st May, this is the purchase 2021, and that S also bought into SS. Like I said, that is what I meant by what I did before. So 2023. So you realize that P bought S and S bought SS. Then this is where the issue comes. So let's say this one was what, 80%, and this one bought like say 45%. Of course, we need to find out if there is nominal control. If P also buys into SS, let's say what, 30%. And the date this is happening is, let's say, 1st May 2022. So the dates are 3. So it gets confusing. When is control in this case? So that's our question. When is control? Because we need control before we can do business combination. When is control? All right. So you see that what you see here, and be very, very careful. So what you see here is that from May 2023, 2022, sorry. From May 2022 here, to May 2023. To May 2023. What happens? From May 2022 to May 2023, what do you see there? Yes. So what you see is that between May 20, this one, as far as P and S is concerned in this period, he has 30%. He has 30%. So you realize that before S buys into this one, so check the date. Check the date very well. So you see, May 2022 is when they acquired this. All right. So as far as May 2022 to, let's say, just before, so let me make it May 2022. So let me call it May 2022. So after May, so you have like something like 30th April 2023, just before 1st May. Just before 1st May. All right. So take note of that. So, all right. Okay. I think this thing is misbehaving. Wow. Okay. Let me get that sorted. What is this? Wow. Wow. This is interesting. Okay. So let me get that sorted. So from May 2022 to the time before S acquired into SS. So let me just use 30th April 2023. Okay. What you do realize is that the relationship between P and S is an associate relationship. It's an associate relationship. Okay. Take note of that. Because he doesn't have control. It is therefore an associate. Take note of that. There's no control. There's no control. So it is an associate. It's just 30%. Take note of that. Then when S acquired into SS, that is where you see nominal control. So you see nominal and effective control. So you realize that from May 2023, what happens? That is where you check for nominal control. What is the nominal control? The nominal control is just for you to know that if P acquires S. So what does it mean? Of course, your nominal control is that P has 30% directly, and he has also acquired 45% indirectly, giving him 75%. All right, so this part is just to confirm that there is control. So it tells you that there is control at this point. And if there is control, then it means that we need to determine our effective control and what? Effective NCI. So our effective control, I know you know. So how do we do it? Effective control is what? You have 30% directly plus 80% of what? 45%. All right. So what is our effective control? Yes, your guess is as good as mine. 66%. And therefore, effective NCI will be what? Will be 34%. So that is that. So be careful. Check the dates very, 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 very well. All right. And if you have acquisition associate, then it means that it's an associate. So you treat it using IAS 28. All right. So that is that equity method. Let's look at the second scenario. Let's look at the second scenario here. So let's have P buying into S. Let's have S buying into SS. So let's have this transaction being done at May 2024, and for which they have 80%. And let's have this one to be May 2021, 45%. And let's have P also buying directly. And the direct part, that is the one that brings out the D shape. Without that direct part, it is a vertical. All right. So 30%. But the 30% is at which date? Let's say May 2022. All right. When is there control? All right. So the issue here is that as at May 2022, what has happened? There is only an associate, because as you see, as at May 2022, that is what you see. May 2022, what you see here is that there is significant influence. So he has 30%. All right. He has 30%. So there is significant influence. So check that, because you see that even though this one is what? May 2021, this P still does not have control. He does not have control. Yes. So what you see indeed is that even though it's 2021 here, S into SS is 45%. So it's an associate relationship. It is not what do you call it? A subsidiary relationship. It's actually SSA, sub-associate. All right. So you can call this one at this point in time SA. It's a sub-associate. So that is what you actually have. All right. So just before May 2022, let me make it like that. So before May 2022, let me call it that. So let me make it clean. So here is 30% actually. And as you see, and the date for this one is what? Let's say May 2022. Okay. So let's make it 1st May, 1st May, 1st May. All right. So what you see is that as at May 2021, the relationship between S and SS, like I said, is kind of sub-associate. All right, sub-associate. So you see what they have in there is an associate. In nominal terms, they don't have control yet. They don't have control yet. Then you will see that when May 20 before, so what you see is that before May 2022, this May 2022, what you see is that they only have significant influence. P has significant influence, and that is associate. It's not control, not a subsidiary. So before that date, that is the only thing that is happening. So they have an associate. Now when they now buy 30%, is there a control, or there is no control? Is there a control, or there is no control? But you see, what you are seeing here is that in this scenario that you see, watch this. Even as at this date, May 2021, P has not even bought S, because he bought S in May 2022. So with this understanding that you have, that we have actually put here, that S in SA is an associate, even at that time, P doesn't have control. So this significant influence relationship that you have, so as at before 2022, it's just an associate relationship between who? S and SS, or better call it SA. So this part that you see, it's just a relationship that is between this. But we are not interested in that. Why? Because as far as we are concerned, this person is an intermediate. But let's look at it from P's perspective. Okay, P's perspective. Because you do well see that as at this time, P has not even bought S. So as far as we are concerned, before May 2022, or even before May 2022, the relationship is between S and SS. So at May, exactly at May 2022, the relationship between P and SS is that it's also an associate. P and SS is still an associate, significant influence. It's still an associate. And that is what we are interested in. As far as we are concerned, this part has nothing to do with us because we are consolidating for P. Take note of that. Then, what do you realize? Then when it comes to 2024, immediately they buy 80% of S, then automatically they've also have 45. Of course, that one will show that there is nominal control. All right. Can I prove to you how the nominal control is? Yes, I can prove to you. So at May 2024, what do you see? Of course, at May 2024, you see that they already have 30%. All right, and they bought nominal and nominal indirectly 45%. So you have 30 plus 45 nominal. Please, key is nominal, which is 75%. So what does that tell you? There is what? Control. So what do we do? So this one, you see that P already had 30% in SS before he acquired 80% of S that added up another. And so this situation is called step acquisition. It is called step acquisition. Take note of that. This situation is called step acquisition. And we will look at step acquisition called, this situation is called step acquisition. And we will discuss that one later when we are doing changes in group structure. So step acquisition. All right, so take note of that. So basically that is that. So just check the dates because the date can result in step acquisition, or it can just be another form of the D shape, the very first one that we discussed, the very first scenario. All right, so how then do we do our consolidation for these ones? Okay, yeah, so you've seen that this one, the situation described here will be your group structure. All right, so let's look at how your working stool will be. Yes, your working stool is also the same thing as you already know. So same. So you will do same as usual. And what is the as usual? You do one for what? The sub, and you do one for what? The sub. So you will do two. All right, take note of that. Then how do we do our goodwill and NCI? Because that is where the issues are. Goodwill. All right. So yes, you do S and SS. So how do you start goodwill? Purchase consideration. And like I said, it can be any of the 5 methods. So you can go and watch, I think that will be video 2 about how to deal with purchase consideration. So that is that. But when it comes to the subsidiary, you realize that there are two forms that has happened here. Directly, he bought one himself. Directly by P, he bought one himself. Then indirectly, he bought what? Another one through the SS. So this is what we have. This is what we are using. So indirectly, he bought 80%. So we go back to how we did it in this initial stage. Where is it? When we were doing for the vertical. That is how it will be. So you go back, so the only difference between the D shape and here is that it's the same thing here, only that there is a direct purchase you have to add. All right, there is a direct purchase you have to add. So the next thing is to do what? 80% of what? What S used to buy SS. All right. So that is the only difference in these scenarios. The only difference in the D shape and the vertical. All right. So now you have to add the indirect one they did. And how do you do that? You use 80% of what S used to buy what? SS. What S used, the amount S used to buy into SS. All right, so that is that. So the purchase consideration in the SS now become 2. All right, so that is that. Then what is the next thing? Yes, your guess is as good as mine. Fair value of NCI at acquisition. NCI at acquisition. All right, how much is the NCI at acquisition? Don't forget, here is 20% we are looking at if proportionate. All right, so you bring it on board. You bring it on board. Then how will the other one look like? Okay. Wow, this is interesting. Let me take off this. Yeah. So how will the other side look like? That's, of course, is the same thing as we did. So let's go and look at our effective NCI. So our effective NCI, let's go and look at it. Effective NCI. Oh, actually, we didn't do those issues. Of course, it's the same thing like we did before, right? Per what we did, let's go and check. Let's go and check. Where did we do our effective NCI? Yes, this there you are. It's 34%. All right, 34%. So the same thing. Okay, 34%. So the only difference between the NCI goodwill calculation between the mixed and the vertical is just the direct. Okay, just the direct. All right, so that is that. Then what else do you less? Of course, if there is goodwill impairment side, you deal with it. All right, but don't forget what we used to do. You less what? NCI share of the S purchase consideration in SS. Don't forget that. So here we have 20% multiplied by the amount S used. So this, the remaining 20% here, all right, in SS. So you less that bit. All right, so that is that. Like I said, if there is issues of goodwill, yeah, goodwill impairment, don't hesitate. All right, so that is that. So if you have goodwill in total goodwill here, Oh, sorry. It's actually the thought we were doing the goodwill. So the same thing that we did here. Let me, sorry. So this is actually the goodwill computation, not the NCI computation. So what do? Fair value of net asset less fair value of net asset. Okay. Sorry for that. You less what? Fair value of net assets of what? SAP. And also the SAP. So you do the SAP here. And you do the SAP here. All right. So that is that. That is that. Then you get your goodwill. So if you get your total goodwill and there is impairment, you do your impairment. All right. So that's that. You less impairment. Okay. So this becomes your goodwill. Carry down. All right. So let's go to the NCI where I actually brought in the NCI share of the purchase consideration. All right. So basically that is that. So you see that if you go upstairs, the goodwill computation when it was vertical is actually the same. The only difference is the direct that you bring in when it's a mixed group. So this side too is actually going to be the same. Nothing changes. All right. It's going to be the same. The NCI computation is the same. So whenever there is D shape, the only effect that distinguishes it from the vertical shape is just the goodwill. It's just the goodwill. That one is the same. All right. It's just the goodwill. All right. So your workings for NCI, you have S, you have SS, of course, NCI at acquisition. All right. That you have used in there already. So you can pick it from your workings 3, but just don't forget that, yeah, also from your workings 3. Just don't forget that the percentage here, effective, is 34, okay? And here it is 20% between P and S. So what do you do? NC, oh, another issue. All right, let me deal with this thing. All right, so we pick up this question all over again to actually look at that. Okay. All right, I think the recording messed up a little. All right, so we have this information about FATO. We have the informations, everything that we need here. Okay, so, and we are told that FATO acquired on October 2017, 60% of the equity interest of Sakara. So our workings 1, as usual, will be Sakara, FATO, sorry. Was actually recording it, but I realized that it was muted, so I'd actually started. Okay, so let me actually go back to this. So as you can see, you are told that they purchased it on October 1st. So this is what you see. All right. So that is it. So they bought Sakara 60%, and you put the date and you compare from that date to the reporting date of the question. And I've, like I said, all these basic things are coming from our workings, our group accounting video 1. All right. So that is that. Then, yeah, if you go on to read the question, the cost of the investment is this for our goodwill computation purposes. And they said that we are also told that at the acquisition date, the fair value of the NCI in Sakara was 146. So good news, we have fair value at acquisition. Then we are also told that on acquisition date, the fair value of the identifiable net asset acquired totaled 417. So that is good. They were also giving us the fair value of at acquisition and net asset at acquisition. All right. And the retained earnings has been given. Equity is also, other component equity is also given. Equity in itself is also given here. So we have them. We have them. Okay. So we have them. Now, if we've been giving these equities and we've been giving the values of these ones to at acquisition, then why then did they give us the total for at the acquisition side? Then it tells you that we need to work, if there is any excess, we treat it as fair value adjustment. All right. So they told us that the excess is actually resulting from a non-depreciable land. That is the fair value adjustment. So that is that. And the Sakara also bought 20 on 2018, 70%. So the same thing, you do your 70% in Sadi or Sadi. All right. So that is that. You also have the information around that. The NCI, which is 30%, we also given the amount, and 50% holding was 80.5 at the date of acquisition. We have the fair value of the identifiable net assets, which have fair value of 181. All right. Retained earnings is given, component equity is given. The excess, they said, is for non-depreciable land. Then we went on to read that on October 2017, Fato acquired 14% interest in Azuri for a purchase price. So this is what you see in Azuri. So this is a vertical plus an associate. All right. And we did the effective in NCI, the effective control. We had 42, then the NCI was what? 52. All right. So for the vertical. Then we come to do the workings too, where our stated capital for the subsidiary, you see here is 200, yeah. Then what next? Other component equity, OCE. How much do we have? In the OCE, we have 18 point at reporting, 18.5 at reporting. What is acquisition? We were told that acquisition is what? 13.5. So that is that. So it means the movement is what? 5.0. So that is what you have. Then the next thing over there was retained earnings. So retained earnings. How much is retained earnings at acquisition we were given? Retained earnings at acquisition we were given 159.5. So 159.5. All right. Then it goes on to say that at reporting, we can fish it out from here. Well, that one is 221. All right. So what is the movement? The movement is like 61.5, right? So that is what we have. But we were given the total already, especially at this side. And so we were told that the total value for all these things is what? 417.5, right? So that is that. So and they said the difference is actually a fair value adjustment. So it tells you that there is nothing like PAP, or a fair value adjustment was on a depreciable land, non-depreciable land. And we were told that difference, so we find the difference. How much is it? So we have 200 plus 13.5 plus 159.5. So 200 plus 13.5 plus 15. So yeah, so we picked the 200, and we also had, where are you? 13.5, and we also had the retained earnings to be this, and we were told that everything on the acquisition date, everything. So the total gives me 373. So I less it from 417.5. So the difference is actually 44.5. All right. So that is what I have. Okay. So here to 44.5 as usual. So when I total this, I'm having 484, and the total of this thing is giving me 66.5. Then I have to do same for the sub fair value of net assets of sub. Sub is called SAD or SADI. So the same thing, stated capital for him, how much do we have? It's 100. OC, other component equity. We were told that this other component equity, its fair value is net asset is 181, retained earnings is 53, other component equity is 10, and at reporting is what? 12.5. So that gives us a movement of what? 2.5. Retained earnings at reporting we have 69.5. Then at acquisition we were told is 53. And that gives us a movement of how much? 16.5. All right. Then we were actually given the total of the fair value of the net assets. And this then is a warning that I've been sounding in the previous videos. So we were told that it's actually 181. So therefore, we need to go through and find the difference, which is the fair value adjustment. They told that it is about a land, a non-depreciable land. So if I do this computation, it means the difference is 18. 18. Then, so this makes this total 200. So don't forget this is 100. And this makes this side 19.0. So that is that. That is that. Then we go to our working strength, which is goodwill. So working strength, goodwill. Don't forget how we draw it out. S and SS. So you have S. You also have what? SS. Don't forget that. Of course, all your currency sign must be shown. All right. Don't forget that too. So the purchase consideration, we were told that they paid cash for this one, right? They paid cash. That is what we are told. So you will see in the financial statements, in SAD is 365. That is what they purchased it for. All right. That is what they purchased it for. So be very, very, very careful. I always advise students to take things very, 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 very carefully. Because as you see here, they said investment in subsidiary Sakara is 365. When you come here, it said they paid cash of 360. The trick is that if you focus on the cash, you are wrong, because the total investment in them is 360, meaning that there is a 5 also there. There is an extra 5 also in there somewhere. So be very, very, very careful when you are dealing about these things. Be very, very, very careful. It's either it's an error on their side that they didn't match the question with the figure that is up there, or there is an element of 5 which is not paid. Be very, very careful. And they never gave us a clue about that. And these are issues in your exams that you need to be very, very careful about. So I beg you that you have to check these statements against this statement. You are told that the investment in there is 365. Investment in there is. So you have to be very, very careful about these things. So there is conflicting figures here and here. But always look at what is in the financial statement, because they told you that investment in, all right, investment in. So it should be the 365. So be careful about that. All right. What about the part in SS, what did we say? You are going to use the CI percentage, all right, to do on the amount S used to buy SS. So the CI percentage we already know is 60%, right, per our group structure workings. Multiply by how much did S used to buy SS? All right. So where is the side of so this is it. Sakara also acquired interest in Saadi, paying cash of 160. So let's go up there and also see. You see, this side is correct. So it tells you that there is a whole inconsistency even in the question. Okay. So that is that. But be very, very careful. That is CA for you. Sometimes you need to check these things. So how much will you have? 96, right? 96%. So the remaining 5, as we go on, let's see the impact of that as we go on, because we are not told whether it's a deferred consideration, we are not told whether it's a liability, we are not told anything about it. All right, so let's go on. So that is how you do that. After this place, I think the remaining is just easy peasy. NCI at acquisition, right? And we were given all those ones. NCI at acquisition for this one is 146. You have it for the 40%, right? And here, what is the? It won't be 40. You have to go and check the effective. Okay. So what is the effective NCI? The effective NCI was 58%. So fair value of NCI at here, your NCI is 58%. And how much is that? I think we were giving that too. The 58% is also given. So the 58% was 80.5. All right, so that is that. Then you less what? So that is our focus. That is our focus. All right, you less, what do you call it? Fair value of net assets. That is our focus for these things. All right, so how much was that? The second one is 181, as you see, 0.0. Then the first one was 417.5. So we less that. Then we get our goodwill. So how much would our goodwill be? So here is 93.5 and here is 4.5. Negative. It's a negative goodwill. Check that. So there are two ways you can deal with it. You can actually do the total to take to your balance sheet, or you can actually record only the 93.5 and take the negative to workings 5, gain on bargain. You remember that? Yeah. So you can do that depending on how you want to carry out with it. Yeah. So if you add it, I think you have what? 89. All right. Or you can treat this one as the one. Oh, first, you can treat this one as goodwill to balance sheet and take this one to group within, and it's 5. All right. It's 5. Right. It anyhow you do it. Okay. As a gain on bargain. Is there impairment in this question? So let's look out for if there is any impairment. So I think we've already read this side. Yeah. They receive dividend. So it's an issue you have to deal with. But my focus is to actually look at what we've done today. Now it says Fato purchased the patent that is used to. So this one too is another workings, which is ISA 38. Impairment tests were conducted for both Sakara and SADI. The recoverable amount of both cash generating units in the individual financial statement were, okay, so we have this. So impairment for this. And is it impairment on goodwill? No. So there is impairment. So it means that we need to do the way this one is phrased, we need to actually watch out to work. It's very tricky. It's very, very tricky. So it's a cash generating units. So you remember cash generating units, IAS 36 impairments. Yeah, so that is that. And respectively, the directors of FATO felt that the impairment test was due to a poor performance of intangible assets, not necessarily the goodwill. Okay, so it was poor intangible assets, and it was deemed that other assets were already held at. What is the other asset? The other asset that you have in this one was the land. Yeah, it was the land. And any other asset in the balance sheet. So it's PPE. These are the assets that we have. These are the other assets. So you have to be very, very careful. I think the intangibles are here. Then, yeah, we have current assets. All right. So these are, we will, because of this, I'll have to complete the solving of this question. We won't just look at what we did today. We will complete the working of it. So we have your 89, all right. So that is that. So a note just on the impairment, let's work the impairment issues. So we had Sakara, right? So this is a goodwill that we will take. Then we have Sadi. Okay. So per goodwill, you know what you need to do per what the question is talking about here is about cash generating units. So you need to bring what you've learned under IAS 36. And they said that per this question, they said the recoverable amount of the cash generating units, these are the recoverable amount. So we need to get the carrying amount of the assets in Sakara and Sadi and compare it with their recoverable amount. Any difference, therefore, will be what? Impairment. So goodwill we've calculated here is 93.5, and this one is what? Negative 4.5. So it tells you that there is no goodwill at all in the first place. So there's no goodwill. All right, there's no goodwill in Sadi. All right, so take note of that. There's no goodwill. So if we are preparing the financial statement of Sadi, we won't bring a negative goodwill there. The negative goodwill will go to group retained earnings. Be mindful of that. So there wouldn't be any goodwill standing in Sadi like a negative goodwill. So this thing, what you do is that this goodwill will go to the SOFP, but this one should go to group workings 5. It's just that for the lazy way you can combine it like this. All right. Okay. Now you have that. Then you have some assets already. You have some assets already in Sadi and in what do we call it? So these are the assets. In Sadi, Sakara, these are the assets that you have. And that total asset is 565. These are the assets. Is 565. So you also have 565 over here. What about this man? You have 297.5. So this is 297.5. So please, I've explained to you why you don't bring the negative here. You don't record any negative in the balance sheet. It will go to rather retained earnings. All right. So that is that. Gain on bargain. Okay. So these are the assets that we've had. And don't forget, there was an asset that is not here, which is the land, fair value adjustment land, which in this case, when we did, the difference was 44.5, right? You remember. And the other one was how much? 18. So 44.5 and 18. So the examiner can be very tricky. Just be careful. So you have the carrying amount of this. Now let's total. It's very, very tricky. It's very, very tricky. All right. My pen keeps freezing. I think it's because the lecture is extending for more hours, but it's because we are actually solving a question. All right. So my focus is to actually help you deal with what we've learned today in relation to the question. It's just that there are some issues popping up again. So here, when I total, what I am having here is actually giving me a figure of 712.5 here. And I have 315.5 here. Then the recoverable amount we are told is for this one, that was the last note, is 712.5. So it tells you there is no impairment. Then the recoverable amount here is what? 302. 302 million. So what does that tell us? Is there an impairment? Yes, there is an impairment because the CA is greater than the recoverable amount. So there's actually an impairment of how much? The difference is 13.5. So impairment, that's how you find the impairment, 13.5. But this 13.5 is not a goodwill impairment, it's a general impairment. So that is why it doesn't affect our impairment. So if you also what will happen is that you have to share this impairment loss. You have to share the impairment loss between the NCI and the CI because the NCI was valued using the fair value method. So you have to share it. So share this impairment between the CI and the NCI. All right. So that is that. That is what you are going to do. Okay. So it's 13.5. 13.5. Yeah. So how do you share this? The thing is in SAD. So what was the effective? Oh, this thing again. Guys, sorry about this. What was the effect? It's only in SAD, so you are going to use the percentage there. I think the effective was 48 versus 52, right? Or 50. We have to go to the top and check. Or 42 versus 58, something like that. So we have to go and check the effective. It's tedious. So it's 42.58. That is what you use to share it because it is only in SAD. So 0.42 by 13.5. How much are you getting? 13.5. I'm getting here 5.67. So you share it 5.67, then the remaining minus 13.5. All right, 7.83. So that is what I have. So that is how you deal with it. All right. Then lastly, let's go to how your NCI will look like. NCI. So you have S and SS. All right. So what I'll do is that I will take a whole revision course to solve all these questions in detail. All right. Other than that, the video keeps elongated, which is not good. All right. So what you do is, what do you need for the NCI? NCI at acquisition. Yes, you need that. And we have actually been given those things. So here was 146. You remember, this is that. We had 146. And for the other side too, we were given that, which was 80.5. All right, don't forget this one is 40% NCI. This is 58% NCI. All right, so that is that. Then what do you do? NCI share. NCI share. is 40% multiplied by, you go to your workings 2. So we will look at the two of them directly. So this one was 19 and this is 66.5. 66.5. So that is what we do. Then here we had to be 58% by what? 19. So this gives us 26.6. And this gives us, let's make it 11.02. All right, 11.02. Now there is impairment, and the impairment was shared. So this part, there wasn't any impairment for this side, but the impairment is actually for this side. And because the fair value method was used, we will have to do 58% multiplied by what? 13.5, which we shared already. So we had 7.83 is impairment. Take note of that. We didn't have any impairment. But what else do you remember? The NCI share of the money as used to purchase of S investment in assets. You remember? So it's 40%. How much did they used to buy assets? We were told that, where are you? They paid 160, and we saw that too at the top there. So that is what we are learning. So 40, 160, that one is straight 64. So that is how you now find your NCI. So ladies and gentlemen, this is how you go around it, doing your acquisition. All right, so that is that, the acquisition accounting. So here I have 108.6, and this side too I have 83. Let's make it 69. Yeah, 69. So that is how it is. So you can then total your NCI, then have, so I have 207.95. So that is how you go around it. All right, it's very, very tricky in these things, but for what we have learned today, that is how this part suffices. Okay, so that is how you go around it. That is how you go around it. So join me on an intervention class or a revision class where I pick up the whole question and I deal with it. But for what we've learned today, these are the 4 steps. I wish I would actually go ahead and solve the questions for you, but it will elongate the time. So we will do all the full questions in a revision. All right. So ladies and gentlemen, learn how to do the vertical, okay? Whether it's vertical and it is a D shape that requires a step acquisition, or is a D shape that is a normal one where you have to do just an indirect and a direct over here inside your group. God bless you and have a great day. So we meet another time where we discuss changes in group structure, and in the revision class where we pick up the past questions. God bless you.